Hi, welcome to the International Luxury Hotel Association for the Inspire 21 conference. Our topic today is hotel owners. So we have lots of hotel owners from the UK, which is great because it's a focus that we wanted to have for a long time. Let's do the introductions now. Justin, do you want to start first?
Sure, thank you very much. My name is Justin Landscron. I'm the Director of Business Development at Q Green Hotels. We are an owner and a management company. We're one of the largest management companies in the UK. We currently have 50 hotels that we manage. We own a lot of those as well. We also work with third-party owners, and we are beginning to expand outside the UK in Europe and Asia, where we're going to be managing hotels for owners as well. So,
which type of hotels do you have? Which
at the moment they're sort of mostly sort of full service hotels. We have a couple of limited service hotels, but we're beginning to expand with more sort of lifestyle brands outside of the UK, in Europe particularly. We also have some sort of full service hotels planned in Asia, in Bangkok. But it's mostly sort of full service hotels at the moment.
Okay, thank you, Justin. How about you, Thomas?
Yeah, I'm Tom Magnuson. I'm the CEO and co-founder of Magnuson Hotels. Company was founded nearly 20 years ago by my wife, Melissa, and I in the US. Today, we're a global hotel chain that what we really focus on is providing worldwide brand support, technology, revenue management to hotels that are unique. While a lot of chains drive standardization for results, we leverage our platform to drive uniquenesses for results. I'm happy to say we're in growth mode. We're just getting ready to release our Q3 numbers tomorrow. Year 21 compared to 19. Our RevPAR is up 21.9, occupancy up 17.7, and our ADR 3.2. And so, we're pretty happy to report those that it's almost, I hope it's not a little too much, but we feel like we're a little bit in post-recovery mode because we feel like for some of our market segments, we have a pretty good degree of certainty about where we're going and how we can build from those. So that's who I am. I'm happy to be here with you guys today.
Thank you, Thomas. How about you, William?
Yeah, hey there. Thank you very much for having me too. So my name's William Laxton. I'm the CEO of McTaggart Family and Partners. That business is effectively a single family office that brings other family offices and high net worths into transactions, real estate transactions in New York principally and London in kind of deal by deal club deals. The family office platform is 125 years old. The wealth was made in real estate and there's really been not so much diversification away from it. So we're very much a bricks and mortar balance sheet that has come to learn the benefits and the pitfalls, but mostly the benefits of operational risk, of which clearly owning and operating our own hotels is a part. So in terms of hotels in the UK, we're a bit smaller than these guys, than Thomas and Justin. We currently have 5 assets operational. We're just about to complete the acquisition of our 6th site, which will open pre-Christmas 23. But yeah, we're growing as well. We're a new brand, entrepreneurial brand operating in a very stable kind of lower risk kind of capital stack type space. And I'm glad to say we've got a lot of investors who are interested in what we're doing and our kind of measured version of risk and the returns it generates. So hopefully I'll catch up one day with the bed count.
Excellent. Thank you very much. Well, let me introduce myself. I'm Alex Sonio. founder and CEO of Global Asset Solution. We have about 80 hotels at the moment. We are focused on helping hotel owners, and we are doing mostly asset management, but also corporate finance. We work a lot in Europe, but the company was founded back in Singapore 15 years ago. So we have hotels across this area. Here today, I'm wearing the cap of the president of the International Luxury Hotel Association for Europe, and that's why we're leading this panel. So let's go to the heart of the topic, and let's start with this question that I hope we're not going to ask anymore next year. Is what happened during COVID? What were the major challenges? And looking back, would you have done something differently? Maybe we can start with you, Justin.
Gosh, it's a big question. I mean, I think I probably speak for anyone involved in hospitality that you know, it's been tremendously challenging, and it remains, you know, it remains challenging. I'm sure we'll, you know, touch on some of these points later on about staffing and supply chain, and these issues which started, you know, almost 2 years ago are still, you know, it's not like they're solved and we're moving on with our lives. I mean, they're still out there. It's still challenging. Luckily, hotels are busy again. Demand is coming back much quicker than people thought. Not in every market, but sort of, you know, broadly speaking, you know, our hotels are certainly going in the right direction. But some of these issues are still, you know, the staffing kind of issue is still there, and I think will remain there for a while. I don't see there being, you know, there's no quick fix for the staffing issue. So it's been challenging. Obviously, you know, hotels were closed. Most of our hotels were open for key workers, but it's been incredibly difficult. And then you now throw in, you know, hotels that are open but don't have enough staff, don't have enough, you know, food supplies and laundry. They can't get laundry. So, you know, demand is coming back, but then you've got these other operational issues. So and also, you know, COVID as well. Let's not forget that in, you know, some guests who, you know, a lot of guests have sort of moved on and it doesn't exist anymore. Then you've got other guests who are still very, you know, emotional and kind of serious about it. So how do you deal with both type of guests at the same time? So it's been incredibly challenging.
And just we talked about this on another call, but it's true that Brexit had an impact. But if we look at it's a problem all over Europe. It's not a UK problem. Staffing is an issue for everybody. I mean, I'm sure we'll allude to this later, but I think that there was an issue in hospitality before any of this happened, in terms of the working environment in hospitality. There was an issue. I think people were fed up of the hours and the pay and various other issues, and this staffing issue was coming. I think Brexit to a small degree and COVID just was a catalyst. And in fact, I read somewhere, I think it was on the BBC, saying that what would have taken 2 or 3 years happened in 2 or 3 months. Right.
So you have a perfect storm, this catalyst that kind of causes this staffing crisis. But I think it would have come anyway in maybe a couple of years. And I think we need to. So yes, to answer your question, I think Brexit was a factor, but not a big factor. The bigger factor was obviously COVID. Right. And I think we have to, as an industry, ask ourselves questions about where do we go from here? You know, we have to think about flexibility for our staff. We have to think about training. Better pay. You know, future career prospects. How people can fit in their families and their life into working in hospital. So all these things, I think we just need to take a big picture look and make changes.
And William, as an owner-operator, you had an interesting approach regarding staffing during the crisis.
We did, yeah. No, I feel very sort of proud and lucky, really, to be able to say that we took a very proactive approach to the situation that was obviously underpinned by really rapid support from the government on the payroll side in the form of the furlough scheme. But we slightly topped up the payroll above furlough so that to show people really that we felt they were very valued and that we understood that the situation that they were in was very volatile and frustrating. And of course, being candid, there's a commercial agenda in that decision. Just like any other business decision, that it has come to pass that those decisions have bred a sense of loyalty, and that we're a real team of people, embracing the challenges that we all face together. But I mean, the wider question that around the major challenges, I totally agree with everything that Justin was saying. Very much as an owner operator, and just as kind of real estate people generally, we're very data led, and the industry, all industries really have become very data led. In fact, managing data is a whole industry in itself. And that was a very frustrating thing, speaking for myself in particular. I've never in my career experienced everything of such a with such a macro element to it. And clearly this was, not just a suppression of revenue, it was an immediate halt to it. So trying to look for themes and extrapolate trends out of data that was basically non-existent or extremely volatile was a real challenge when you're trying to manage stakeholders, lenders, shareholders, and just interested parties. So in terms of adding to what Justin was saying, that was always struck me as the key challenge that we faced. Along with communication, obviously, because as great as this is, seeing digital faces and hearing digital voices, it's there is no compromise, and I genuinely don't think I say that as a self-interested real estate investor, but there is just no compromise with human contact. And that challenge for us, where we are very HQ kind of led, we don't really know one single person is making a decision on their own. It's very collaborative. There's a lot of transparency around key strategic decisions. And to have to do that, over a phone call or Zoom and Teams and these sorts of things, it didn't come naturally to us as a business. And I think actually, that's part of the bounce back that we've seen, is that people really understand and have learned that there is no substitute for human contact.
And you mentioned at the beginning data was very important to get the right data. I mean, we all cut costs as much as we could. We were very focused on the cash flow. Reforecasting was very difficult, I'm sure, for you guys.
Yeah, I mean, I think within the question was something like, would we do something differently? We would have spent a lot less time reforecasting. Obviously, it's easy to say now because there were sort of multiple versions of lockdowns and legal closures and restrictions, but really, it kind of felt futile at the time, and now I think. I think we would like to say that in a similar situation, God forbid there is one, but if there were one, I think we would hope that we all had a bit more sort of trust in the model, and that it would recover. We would like to think that we would recover better than the market, because we're a small, nimble business, and we can do that. Otherwise we'd just buy shares in listed hotel companies. But yeah. Forecasting and strategic thematic thinking, when really in a daily trading business you're kind of living with the 6 inches in front of your face, was kind of more stressful than it needed to be, perhaps.
And how about you, Thomas? You have hotels in the UK, but also in the US. you saw the differences between different markets regarding national government support. What's your take on this? Was it good enough? What's the situation today?
Well, I think both countries, we've seen similar platforms for support. You know, we've seen furlough, rent freezes, business rate holidays. But the situation we're seeing today is that these were just plasters or band-aids that were put on the problem. Mm-hmm. And as we peel them off, we're seeing a more difficult situation. Justin, you mentioned, you know, the labor shortage, of course, the supply chain, where everybody knows about that. One of the things that we've really seen that really has not been talked about is as the labor shortage has continued to escalate, we've seen in many sectors a deterioration of motivation or morale from the owner sector, from the individual owner sector. And I want to put that in a historical context because I've been involved in hotels since the early 1960s. And so when you look back over decades, you can, and then when you look back, you can see some things. But in the most recent period, 20 years, the 1990s were pretty great years for just about everybody. Mm-hmm. And then along came 9/11, which was something no one had ever seen. It took 7 years to recover from 9/11, everyone. And then as soon as everybody got on their feet, it was 2008. Then it happened again. And then here came 2020. And so I think when you talk about the situation today, underneath the supports, the issues that are still there, they're the ones that we talk about today. But a more difficult one that we see is how to convince owners that actually there's much more business out there than they seem. They've just kind of gotten hammered by these three major global events. They feel like the business has been hijacked from them by the complete invention of the OTAs since 2000, which is a relatively new phenomenon. So there are some things underneath. We see a lot of people talk about, we wish we could go back to 2019. Those were the good old days. But again, they were good in terms of the highest volume in history, but it was the slowest RevPAR growth since 08 for several factors, such as, you know, just so much supply coming into the world, certainly from Airbnb and the sharing economy. But, you know, despite some of these things, we're pretty optimistic, as I pointed out a minute ago, that the situation today is, even though there've been so many of these macro challenges and then lower level ones such as labor and supply chain, the amount of people traveling is growing at about 4 times the GDP of the westernized countries. And so they're just traveling in different ways. And where we're finding it with hotels here in the UK and in the US is with fresh approach to business segmentation. And hotels had each hotel that exists has traditionally been dependent upon a core set of business drivers. Well, those all just got thrown out the window last year, right? So if you were at a city center, across from a convention center, you always knew exactly what it was going to be every year for the next many years. So those people are going to have to look to new sectors. Predominantly leisure hotels are going to have to look to new sectors, but we're kind of going back to the old school method of the old phone book and the sales manager about 25 years ago, where you call around and you look around at how many local businesses there are with you within a 30-mile radius. how many new corporations are moving to town and actually calling on those people and asking for the business.
Thomas, maybe this I should ask also William. About the governmental support. You use CBIL in the UK. William, you have hotels in central London. How was it managed? How did you get support? Was it easy to get? Do you still benefit from this? What was the situation?
Yeah, so we. I think so. My view of the wider sort of UK government support is that it was actually pretty impressive, principally because it came in a variety of forms and it came very quickly. So there was support on payroll, but there was also support operationally through VAT and someone alluded to rates as well. But on the capital stack side of things, for us. To create immediate liquidity through the CBIL scheme, which in the UK was typically run through one's senior lender, with 80% of the loan amount being guaranteed by the government. Really, in that kind of, back to the forecasting, really, in that window where, first half of 2020, the window of time where forecasting was very difficult, and as an investor, you're always looking for a return on your capital. You don't just sort of pour money into something just because you're protecting what you've already invested. You also need to understand what return that capital is going to get. Whereas, of course, the CBILs were designed specifically to solve that problem. They were quick, they were cheap in terms of interest. And they were very much representative, I suppose, of the bigger picture around alignment of interest and the economy as one entity with many participants in it. And I think I don't know so much about other Western economies and necessarily that whether or not the measures they took were as specific or as broad or as deep. But I think the UK, as a package of things, it was really quite astute and it was very fast, I would say, certainly compared to other parts of government and other countries.
That's very good news. So now we saw the help, the support from the governments. How about the lenders? And this question is going to be for you, Justin. Do you think the support was appropriate? I mean, would you agree that there is limited distress assets because they wanted to keep the asset on the owner's side, or is it just a delay before a big wave? You're on mute.
Personally, I think it's important. I mean, we don't have debt in our business, and we're not sort of buying stuff at the moment. But obviously, we're talking to a lot of people who are looking to buy, and we're looking, we talk to the banks and funds, because we want to work with those parties. So I think it's important to point that out. But my views are purely based on sort of anecdotal, conversations. Clearly, the banks, as Will said, were very helpful and have remained helpful and supportive, and that sort of carried on through the sort of the dark days of COVID. And I think that the phrase people used was there wasn't distress, there was stress. But I think that intuitively that's going to change, and I think that is changing. I think that there are going to be they probably have already been asked some serious questions, or they're being asked right now about what to do with certain hotels, because look, the reality is that yes, the demand's coming back, but it's not happening everywhere, and it's not happening maybe as quickly as people would have liked, and people who already had debt have got more debt because of CBILs, and all the other things that would have stopped. Furlough has stopped, the VAT break, and council tax breaks. All these things are all coming back, so it's kind of like a bit of a perfect storm for some hotels is coming. And I think you said, is it just a delay, kicking the can down the street? I think that is the case, and I think that my view is probably Q1 of next year. I mean, we're already at Q1 next year almost. Q1, Q2, there's going to be some serious questions and serious action. And I think more and more things will come to the market. I mean, we're going to talk about this a bit later, but there have been things, but it's been small amounts. But I think that there must be conversations in the shadows happening now about things, portfolios here and there, and because I don't know how they can pay all this debt. So I think that even if the good times came back, I think they would still struggle.
And William, what's your opinion on this? Do you think it's happening early Q1 next year, or more towards mid-year, or you see already some? Yeah.
I see a slightly different scenario, to be honest. I mean, there are no one thing ever happens in a vacuum. There are always multiple numbers of inputs and variables in a situation, and one of the major distinguishing features of this market versus, say, 2008, 9, 10 is that interest rates are so low, and in addition to that, private capital and more capital with a sort of broader spectrum as to investment rationale is available now, such that ironically, even if a individual sponsor or an individual asset or portfolio owner was in true distress, I don't see it affecting capitalization rates. I don't see it affecting asset values, and the kind of the sort of initial opportunistic reaction to arise from COVID is that there would be some kind of blood on the streets, and the quick, well-capitalized amongst us would be able to sort of get the mop and bucket out.
Right.
And really what I imagine as more likely happening is that pricing will be maintained broadly. Cap rates won't suddenly soften to 6, 7, 8 when they were 4, 5, 6. And I think that the capital has been raised opportunistically, and it's not finding a home. So there's this supply and demand imbalance that underlies all of the micro operational led distress. And I think the more likely scenario is that lots of joint ventures will be formed. We've probably begun to see a bit of that already. People with good solid businesses, but maybe not as much capital as they used to have, or not as much capital for growth, or capex, might find people desperate to deploy capital who just can't transact. Right. And I think that will be a really interesting theme that might actually kind of overtake the more kind of simple binary for sale sign going up, and I don't particularly see a kind of bank-led, take the keys, getting back, pence in the pound, the way we would have been used to in 08, 9, 10. That's how I kind of see it panning out at the moment.
Okay, thank you. And now let's speak about the operators. I mean, Thomas, you work with different operators. For me, they were flexible. Some others were not flexible. What I find it hard is the reopening and the lack of support that we had in terms of sales and marketing, because they had to get rid of so many layers on the corporate level. What's your perception, Thomas, on this?
Just what we've seen by and large, Alex, is that yes, there was a significant cutback in corporate headcount and therefore corporate resources at all of the big publicly traded chains. Marketing, technology support, revenue management. Marriott, for example, I think cut 32,000. I mean, there was some very, very swift big moves that were made, but we have not necessarily seen those being refilled or to a commensurate level to take care of these reopenings. And also what we're seeing right now is in addition to reopenings or hotels that were open, is again, I'll refer to the necessity to rebuild business segmentation. And many of these large chains were very truly built for scale, but not for the detail of local and regional marketing bases. And so, as businesses shifted toward many of these areas where, like the Fortune 100s or 200s might not be cutting back a lot, the SMEs and the privately held people will still be on the road for business. So the drop in support has left a lot of these hotels struggling to find a way to get that. One of the things I think that's been interesting, and I don't know what to really make of it, is that as many of these corporations have cut their support to the property levels, what we've seen is that decisions made at the property levels, such as pricing, revenue management, have become have been taken away and removed and been centralized to HQ, and so pricing decisions, market selection, and we've seen across 50 states and many places in the UK, has been removed from the property level, absorbed by corporate. But further, the revenue strategy has been incorporated into automated bot strategies that are, for the most part, and we're seeing this in Marriott product, Hilton product, driving high occupancy, what we'll refer to as an OYO strategy,
right,
that is not focused on RevPAR, but and then we're seeing the last thing I want to mention on this is the conundrum of pushing a high occupancy strategy in an environment where we're having supply chain issues and labor shortages. So there have been impacts. I hope that as the recovery happens, that a lot of these resources will get filled back up again.
But Thomas, it's funny you mentioned revenue management, because I see for a lot of the operators, they rely on the new software of revenue management, and there is no human behind it, and they follow the pricing strategy. The problem with this is like the historical data doesn't match. That's how you build your future pricing, and it's very difficult. The way we approach it is for all our hotels is like, okay, we look by segment, per week. We look also by type of room. We look by weekend, weekday, and we have like revenue calls like every week with all our properties, because it must be done. You need to have the human touch. You cannot just rely on software. So it's a very good point, and that this is like the only way to push the ADR, because if we can rely only on occupancy, that's not the way. We know that ADR is crucial more than occupancy.
One of the interesting, what I just want to point out on this, one of the interesting phenomenons about this is that you talk about the historical data, but dynamic pricing has really only been adopted in the last 12 to 18 months.
Mm-hmm.
I mean, we had dynamic pricing certainly in cities like London, Las Vegas, New York City. Were very dynamically priced, but we've now moved to everyone, because of COVID, with no forecasting, has moved first to manual and then to automated dynamic pricing. And so the bots are just built upon a very short-term recollection of data and certainly no historical basis. To your point of, it's good to automate things that take up too much time, but you got to make the personal decision in the end.
Yeah, I want to go back to one point, and this is maybe for Justin and William. We're in the service industry. We shouldn't forget this, and our talents is our people, and it's really important to have that you mentioned at the beginning of the call and throughout this discussion that it was very difficult to find the right people or to find anyone. Do you think we lost a little bit of know-how in the luxury industry? Do you see how, it's a perfect storm what we had. How do you see the recovery? How long is it going to take to go back to 2019? And what the industry should change to attract again talent?
I mean, look, as I said, we've had a crisis. Let's not, let's get to the crux. It's been a crisis. I mean, and when these type of events happen, you have to ask yourself, deep questions about why this happened and how can we improve? So my view is that we're in a crisis. How long is it going to last? I don't think anyone really knows, but when this is over, we'll be better. We'll be better for it because we're going to make changes and we're going to make, it's not going to be the same. It's, the industry won't be the same as it was before. As I said, we're going to maybe pay people more. We're going to train people better. We're going to allow them to be more flexible. All these things we have to think about, because at the end of the day, our industry is a great industry, and it's much better to be in hospitality than it is working for Amazon or for Tesco. The problem is at the moment they're paying more than we are, so we have to. That's just one thing, but I think once we start to answer these these hard questions and make it better, people will in time come back. Also, once there's more stability, I mean, I'm sure everyone's heard sort of anecdotal stories of people leaving, certainly in the UK, because hotels were closed. They're not from here, they haven't got family, they've gone home, but they would love to come back, but they need stability. So once there's stability, once it's a little bit more attractive, once we've kind of fixed these issues, I think people will come back to our industry because it's a great industry. It's exciting. It's every day is different. It's people. It's hotels. I mean, it's. But for now, it's if you're looking for a chef in York, good luck with that, because it's basically impossible. Or if you do, they want double or triple.
Now, Justin, after this, it's free advertising for the position.
Yes. Yeah. Well, no, if you do, if you find a chef somewhere, they want triple what they wanted before, or now the power is with the staff, with the they're in the driving seat. But I think in time it will fix itself. People will come back to the industry. People will come back to the country. Unfortunately, companies and businesses will go bust. Those people will need jobs. So they're, so.
But it's a hard. I mean, it's the issue is okay. The owners often focus on the hardware, the building, and buy more and develop. But now our focus as owners is more and more the software, and the software is the people. You can have a bad hardware. We all know that. But if the software is good, our people are good, guests will come and they will be happy. Yes, the renovation will come later, and so it's the most important area that is affected, the software.
I agree. I mean, our owners, they're not, I'm not, they won't like me saying this, but they have to look at, it's not just them, it's any owner of a hotel. It was the industry, they need to pay people more. They need to look after people better. That's just the reality. And then owners can try and dodge that, but the reality is that they have to change. We have to change as an industry. We have to change because, as I said, these issues were there, and what's happened in the last few years has been a catalyst to just speed it up.
And the operators need also to make the job more interesting, make them have a potential growth. It's not just about the money.
It's about, as I said, it's about flexibility, it's about money, it's about training, it's about future, career developments. It's all these factors that have to be looked at and incorporated.
Yeah, I agree. I think it's this one topic alone is something that I think we could spend an hour talking about, particularly as an owner operator. I feel very interested by it. I mean, at the time we felt very unlucky, but in hindsight, I feel very lucky that it was in February 2020 that we launched our new brand, which is Resident Hotels, with the CEO David Orr, who is a sort of best in class operator, and he's really taught me and us as a business on the ownership side, the asset ownership side, about the value of reputation, and guest feedback, and in a market where it was very difficult to make a site operating profit, actually emerged an opportunity where you didn't need to worry necessarily about revenue because there wasn't a lot of it. So what we decided to do was follow really quite obsessively a strategy led by the teams of people in each individual hotel that was just obsessive about reputation. Because by getting that piece right, we were therefore building the foundations for revenue to recover, and for us to be shown more real estate acquisition opportunities, and for us to be shown opportunities to manage other people's assets for them. And with Resident and with that kind of people-led delivery to create reputation, and also by alleviating those people in the individual assets of the responsibility to be commercial and just focus on guest experience, I think we've actually emerged much stronger than perhaps we would have done. We're kind of, to put it into kind of corporate speak, we're leaner than we would have been operationally, and that kind of that runway from May this year through to now was like nothing that we've ever seen before, but hopefully we'll never see it again, where the whole sector was reopening at the same time. It was like every hotel in our case in London was new. And that's never been, that experiment has never been undertaken before, but it kind of created a very level platform in which you could thrive. Everyone was starting from the same place, and reputation is delivered by people. So I agree with everything that Justin's saying, and particularly with the point around the issues were there, and they were just massively accelerated by COVID. I just wonder if there is also something that we need to be aware of, as not just as hoteliers but as consumers ourselves, that hospitality in the UK is in the context of the UK's culture, and hospitality, be it food service or delivering rooms for people to stay, it doesn't have a vocational element to it in the way that it would do in Italy or France or Spain or lots of other places in the world. And I think that's part of the problem that we have as employers of teams of people delivering hospitality, is they're delivering in an environment where fundamentally they're undervalued. We don't have a very well-established tipping culture in the UK. It's kind of been forced down consumers' throats rather than the celebrated opportunity to show the people who've just worked hard for you that you value them. So it's complicated and not easy, but within all of that, those are the best kind of situations to go into business. The more disrupted, the more unstable things are. Hopefully that should mean more opportunity for people who are prepared to pay a bit more, think a bit more carefully about the lifestyle they're creating for their team. And that should be something that we're kind of excited about rather than fearful of.
But it's really interesting, because as owners, we are going back to the fundamentals, the service, our people. So I think that's good that it's not just from an operator or operational teams asking this, but it's owners realizing that it's so important. So that's a very interesting area that you discussed. Now let's go back to something more maybe easier that we comprehend a little bit better: hotel transactions. do you? I'm seeing with our hotels in the south of Europe, there is huge interest for resorts. I mean, it's working. It worked really well. The hotels perform extremely well this summer without international, well, outside Europe business. Do you see a shift also on your side, the approach towards resorts, and how do you see hotel transactions going forward? Are you going to focus on specific markets? Are you still, do you believe that some, the old focusing only on key cities approach is the best way? What's your take on this? Maybe Thomas, would you be able to elaborate on this, please?
Sure. Well, we're going to take a reverse approach, Alex, and I guess this is probably not intentional but accidental. But we found the old saying. Sam Walton was the founder of Walmart, and he had a saying: "You'll never believe how much business there is in a small town." And so he intentionally built his mega centers in non-competitive markets that were big enough that were very, very profitable, but not big enough that would attract loads of competitors. And so what's really worked well for us is certainly across the US and UK, secondary, tertiary highway markets for us are attractive properties. I mentioned this when we talked the other day. I call them functional properties. They're not sexy, they're not glamorous, they're certainly not resort properties. But if you're thinking about what would be of an asset interest to us, it would be these types of very, very stable, high consumables that will continue to grow with travel and population development.
Okay, how about you, Justin? You have I believe that you have a huge appetite towards the UK, but at reasonable price, I guess. What's your view on this?
I mean, we have 50 hotels, around 50 hotels in the UK. We're looking for more hotels in the UK, or to manage more hotels. We're looking outside the UK. I mean, I know, again, speaking to funds, I mean, I know there's been huge appetite. Well, there's huge appetite generally, but for places like Spain, Portugal, resorts kind of locations in those markets, I know has been very, very active in the last, say, 6 to 8 months. There's been lots of transactions in those kind of markets, and people are sort of gearing towards sort of leisure resorts kind of hotels and markets. We are, as I said, the UK is a big focus, and there is huge appetite. I mean, everyone you speak to everyone's looking. They've all got funds to deploy, but there's not a huge amount of them for them to sort of get their teeth into, or at a reasonable price. So we're looking in the UK. We're looking outside the UK. Some kind of leisure for our lifestyle brand, sort of leisure locations. But a lot of the stuff in the UK is sort of your traditional corporate kind of corporate locations with maybe with some leisure. There is huge demand, but there's still not a huge amount going on, I don't think. I mean, certainly in the UK you read about transactions here and there, but it's not, I think William alluded to it, it's not on the level that people might have anticipated. There isn't this wall of distress, and there is a wall of cash for sure, but there isn't a wall of distress. And that might never happen, as William mentioned. That might never happen. It might just still always be like a trickle of stuff. But so I guess we're focusing on a lot of city centre, primary, secondary kind of locations and markets. We're looking at our sort of lifestyle brand outside the UK, but that's mostly developments. and hopefully there'll be more transactions in 2022, because I mean, a lot of conversations we're having with people are, oh, we looked at this, but it's just too expensive, it just doesn't stack up, or we looked at this and we got outbid, and then nothing actually happens because it just falls away, or so it's, yeah, there's a lot of appetite, but there's not much high demand but low supply.
It's going to be William, you wanted to say something?
Well, yeah, I mean, look, I think there are a few things happening in this one conversation at once. I mean, I think a lot of capital at the moment might be more revenue orientated than it was historically, so income led rather than capital appreciation led. And some of that is to do with timeline, some of that is just to do with underlying investor requirements. But you know, we would typically look at a total return of income and capital appreciation. But crucially, I think there's two big words which haven't really come up so far in this conversation. One is risk, and the other is inflation. I think for lots of reasons, people have their own specific views on inflation, albeit there's, you know, a degree of herd mentality at the moment on it. But you know, where we all seem mostly here to be talking about hotels with operational risk, so not leased to an operator, and that is extremely attractive to capital looking for a home, because effectively, you know, it's inflation proof. You know, clearly costs rise, but so does rate, and I think that's one of the underlying themes around why, along with the sort of you know, anticipated distress from 18 months ago when the capital was raised, that's one of the things that's happening. But I personally think that the kind of leisure-led, resort-led strategy misses a big piece of understanding the risk. I mean, there's no such thing as a return. Everything is a risk-adjusted return. And it's very easy in a financial model or in an investment memorandum, a prospectus for an investor to talk about returns. But if you're not communicating how they're getting them, you know, it's kind of meaningless. And a lot of what's going on at the moment is kind of saying, oh, well, you know, central London is highly exposed to corporate, to business travel, to inbound US, Asian revenue, and it's not there. So let's go and put our money somewhere else where the revenue is there, like a resort, you know, a hotel in Cornwall. Great, it makes a lot of sense if you're deploying your capital and you're looking at data to the point around you know, automated led revenue management. If you're looking at a data set that's June 21 to September 21, you'd think wonderful. There's so much yield on this. But it's very dangerous to kind of, you know, allow oneself to be drawn to themes that aren't really themes yet. And I really feel that about resorts, and in particular, you know, I don't know a huge amount around employment law, you know, legal structures in some of these countries. So that's more the reason why we wouldn't invest. But it's very much the case that on a risk return basis, I could never get there and sort of say that return is deliverable to an investor, you know, to my shareholders.
It's a short-term vision, maybe.
I think so. I think it's, you know, we're not out of I think we would all say that we're kind of, you know, are in that post-COVID era, but that doesn't mean that there isn't lots of volatility, you know, on the way up. It's not a linear recovery. It's a pretty spiky, volatile line, I think, back to stability.
It would be very interesting to repeat this every year with you guys, with the same group. To see the evolution. It's like, okay, now the software is sorted. Now we can start buying more hotels and see where you guys invest. That would be very interesting.
I think it's just on the. I think a lot of funds have got a bit of a dilemma, because on the one hand they've got to deploy these funds, right? And if they don't deploy, they're not a bank. They need to earn their asset management fees, their promotes, etc.
Yeah.
But there's not exactly a huge amount for them to look at. So they're kind of, is it better to do no deal or to do a deal that is, you know, ticks 80% of the boxes? Or so there must be, you know, there must be, it must be tough for them, I think, to sort of, what do we do? Do we do nothing or do we do something?
But it was the same thing in 2019, where the price was so high, it wasn't worth buying in many ways. So hopefully this coming year, we're going to have more opportunities.
Yes, absolutely. From your mouth to God's ears.
All right. Well, thank you so much for your time today. And hopefully we can reorganize a call like this next year to see what changed. And I wish you lots of success for this coming year. All right. Thank you very much for attending this conference, and we talk very soon. All right.
Thank you.
Thank you. Bye-bye.
Bye.